2007, I wrote a paper with Hyun Shin for a BIS conference on the leverage cycle. And so this session is about thinking about theories of financial crisis. And so our theory of the financial crisis was one of a leverage cycle. And so what I'm going to talk about today is sort of like in retrospect over the past 10 years, how would we look at the leverage cycle and what has been the impact of regulatory reforms on the leverage cycle. So the first order impact is visible in this chart. So this is showing leverage defined as total assets over equity for banks in advanced economies in red here, and then a couple of sub-regions like the United States, Europe, UK, and Japan. And you can see very nicely that leverage ran up in the run-up to the crisis, right? So for example, for major advanced economies, leverage was around 20 in 2002, went up to around 25, and then peaked in the, something like 27, 28, and then before declining sharply in the crisis. And then, of course, even though financial conditions are very easy today, so both Doug and Raghu pointed to the easiness of financial conditions in the current environment, even though financial conditions are very easy, we don't see a recurrence of the leverage cycle, right? So, one might expect that, well, we're in another boom, why isn't leverage going up? And of course, there's an answer to that. And the answer is this. A lot has happened in the past decade, which is related to regulations. There's Basel III, there are the stress tests, there are market risk amendments, Tier 1 capital rule, the Dodd-Frank Act, leverage, liquidity ratios, TLAC, right, for resolution purposes, capital conservation buffers, GSIB surcharges, et cetera, right? When you talk to strategists from banks, when they try to optimize the balance sheet of a bank, they write down something like 40 constraints, like 40 regulatory constraints, and then you have to optimize how to run your balance sheet in order to maximize profits for the firm. So the world has not only become more regulated, it also has become a lot more complicated because you have so many constraints to take into account, right? And so clearly that has done something. So leverage is lower, even though financial conditions are very easy. And we do see leveraged lending going through the roof and underwriting standards are deteriorating in the market system. Clearly in the banking system, leverage is not going anywhere. So point number one is there is a leverage cycle, and the leverage cycle has been tamed due to regulation. So what are some like the first order effects of more bank capital? So this is a scatter plot. So this is a scatter plot for a sample of banks from the mid-1990s to the mid-2010s across the globe, 200 large banks. And basically the first order thing is that when you have more capital, your funding costs, so these are the non-equity funding costs, are lower, right? Because you're less risky. So this is very clearly in the data. Secondly, banks with lower leverage raise funds and expand the lending at a faster pace. So when you have less leverage, you react more to changes in financial conditions, and and this is visible both on the asset and the liability side of the balance sheet. So this is sort of like, this is like very good news, right? Now, of course, the impact of less leverage on the cost of funding is sort of like declining with the level of leverage, right? So the less leverage you have, the less the marginal impact on the cost of funding, which I think is both intuitive and consistent with theories we wrote down. Now, having said that, of course, we do have less leverage, but at the same time, the mechanics of the leverage cycle are still valid. And so this is sort of like the first order finding that we presented back in 2007, and this remains true, so you can verify that even in post-crisis data. And so when you look at the balance sheet of banks and other intermediaries for that matter, when you look at the correlation of total assets with liabilities, you basically get an R-square of 99.99%, right? So banks adjust balance sheet size by adjusting liabilities, non-equity liabilities, while the equity cushion is pretty much fixed. So the blue line, the blue dots, this is the equity cushion. So as banks are expanding and contracting their balance sheet size, bank equity is pretty much flat, and so really what is moving around is leverage. And so this notion of leverage and the leverage cycle continues to be true, even though we are, of course, operating at a much higher level of bank capital. And so the leverage cycle is very much related to what Arvind talked about earlier, and what Doug talked about earlier, and what Raghu talked about last night, which is that during times of easy financial conditions, risk management systems are going to tell you that you can take on risk. And of course, you take on risk. Balance sheet size is expanding, leverage is expanding, and eventually bad shocks occur. The system is fragile, and deleveraging occurs. So, one place where that does play out is in the repo market, where, of course, haircuts are set relative to the riskiness of collateral. And this is in particular in the repo market that is funding the buy side. So this is on the asset side of the dealer balance sheets, right? So their haircuts are calculated according to risk management metrics. So when you're in the boom, volatility is endogenously low, haircuts are low, and leverage is high. And then there's the reverse of the leverage cycle once bad shocks occur. Now, when we look at the dealers in particular, so dealers, on the left-hand chart, you see the dealer balance sheet normalized to 100 in 1990. And you see that dealer balance sheets used to grow exponentially, just like household balance sheets and non-financial corporate business balance sheet grow exponentially. They used to grow at a faster rate because sort of like the market-based system used to expand quite rapidly, and the share of market-based finance used to expand, and dealers are sort of like at the center of the market-based financial system, which as economists we all appreciate as very important, of course. Now, what has happened is that, of course, in the crisis there was a slowdown in this growth. So total dealer balance sheets came down from close to $1 trillion to something like 600 billion, so a very, very sharp decline. And you also see such a decline in the total balance sheet size of households and non-financial corporates. But of course, the households and the non-financial corporates went back on the exponential growth path, right? So you had exponential growth, you go back to exponential growth. But this is not true for the dealers. So the dealers just completely stagnated. So dealer balance sheet size stagnated roughly at the level that they first reached in 2003, right? And that goes hand in hand with the deleveraging, right? So which is shown on the right-hand side. So now, of course, this is not causal because it's hard to get causality. We don't have an instrument, etc. But it is suggestive that, the way in which things are regulated and so like the way that intermediation is done has shifted quite dramatically. So I want to zoom in a little bit more at the actual composition of the dealer balance sheet. So when you look at that, so you can see that dealers had a very large corporate bond position. So this is from the New York Fed data. So here what is called corporate bonds does include a fair amount of securitized assets as well. So basically, they ran up a long-short position, being long corporate bonds, including securitized assets, short treasuries, and then this long-short position was unwound very, very rapidly. And basically, since 2008 or so, they have sort of like a flat position, long in both corporates and in treasuries. So very, very dramatic change. And of course, this kind of balance sheet behavior is related to expected returns. So when you look at the share of debt securities in the financial assets of the dealers, this is very, very closely tied to what I proxy as an expected return for fixed income securities. So here I just take like a credit spread plus a term spread, right? So basically what you earn as a dealer, right, is like a credit spread and a term spread. And this correlates very, very closely with the share of fixed income assets on the dealer balance sheet. So of course, the way that the dealer balance sheets are managed is related to returns. Now, another way to sort of like ask this puzzle is that normally when volatility is low, value at risk constraints are loose, which allows to take on leverage. And so this is what is shown in the left chart. So these are the value at risk, so you can actually pull value at risk numbers for the largest institutions. And this is very closely tied to market volatility. I use the MOVE index, which is treasury volatility here as a proxy. And so despite the fact that volatility is very low, as I showed you earlier, leverage continues to be very low. So clearly, regulations have done something. And I think when you talk to market participants, where you can see that first order is when you look at things like bases, right? So bases are things like the CDS bond basis, right? So this is, in principle, if you think about textbook finance, something that should be arbitrageable, right? Because you can put on positions in the bond and positions in the CDS, and you can have a kind of convergence trade that is going to pay off for sure in the long term. The problem is it costs balance sheet. There's a balance sheet cost. And with all these regulations, of course, balance sheet cost has increased. And so these bond bases are suddenly very large. Similarly for the 10-year interest rate swap basis, right? So it's just that because it costs balance sheet space, you now have risk-free arbitrage opportunities in the market, or what is in the textbook a risk-free arbitrage opportunity. Similarly for FX swap bases, these continue to be very wide. And there's some very interesting work at the New York Fed going on where they link bank by bank positions data to the tightness of these balance sheet constraints. So yes, dealer are more constrained. Dealer balance sheet capacity clearly has not returned and hasn't kept up with the growth of the economy, and that does have an impact in terms of intermediation. I mean, furthermore, of course, securitization activity also is massively smaller, right? So the way I think about the world is that the world of finance is that there's bank intermediation, there's market-based intermediation, and then there's securitization activity. And securitization activity also ran up a lot, and there were all the problems with the underwriting standards, that were extremely severe. But it has, and those problems are solved because the activity hasn't returned to a large extent. So there's some securitization activity. There is in CMBS, people do worry about underwriting standards, but just the magnitude of overall securitization activity is just nothing today compared to what it was 10 years ago, right? So these are very, very significant shifts. Now, when you look at what the FSB calls shadow banking, so it was just renamed. It used to be called shadow banking, and now it's called non-bank credit intermediation. So the FSB has started to collect all this non-bank credit intermediation data. And basically what has happened over the past decade is that the risky type of shadow bank credit intermediation, which is related to securitization, has declined quite dramatically, while the other part, like the healthy part of credit intermediation, which is like asset management essentially, has increased. It's never clear to me why the FSB classified asset managers as shadow banking in the first place. I think there's some maturity transformation and some credit transformation that is happening in the asset managers, but basically asset management is like, the healthy kind of market-based intermediation that we want to see as economists. And so, of course, credit intermediation in the asset management sector has increased dramatically, and leverage in that sector is very, very low, right? I mean, a typical asset manager has much lower leverage than any bank, right? Does that mean we don't have to worry at all? No, we do have to worry because there are some weak players out there. So for example, you remember Third Avenue, right, was a high yield bond fund that was taking massive amounts of risk. So you have sort of like the core high yield funds out there that are well managed, but then there are some guys, that are taking huge amount of risks. They were not even invested in rated products, all right? I mean, they were, just taking a lot of risk. Now, when they blew up, there was a little bit of a spillover to the rest of the sector, but it was not like the kind of massive spillover that some people are worrying about. So, but of course, there was an environment of easy financial conditions. So, there's this question of once we are in the next downturn, once there is the next financial crisis, are there going to be more spillovers across asset management investors, right? Because these guys are giving the asset managers assets to manage, but if they pull out, what's going to happen? So we don't quite know, because of course with more leveraged loans, more corporate bonds, more high-yield bonds in that segment, we don't quite know what that is going to do in the next crisis or so. So in 2009, there was the Pittsburgh G20 summit, and basically that laid out the strategy for the regulatory reforms, which was on 4 pillars plus one here, which is the other stuff. And so, number one, building resilience, basically having more capital, higher quality capital, and more liquidity. So that has clearly been achieved, right? So the banks are much safer. Ending too big to fail, I didn't talk about that. So the resolution regime has been phased in pretty much in the jurisdictions that house GSIBs. And the TLAC, so the long-term debt that can be bailed in, has increased. It's not quite at the level where it should be, but it's heading in the right direction. Making derivatives safer, there has been a massive shift to CCPs, so to central clearing. Now we have, of course, the new institutions, which are the CCPs, which have to be regulated appropriately. And there's quite a lot of work on that going on at the FSB at the moment. So I would say there's movement in the right direction, but it hasn't quite finished yet. And then there's shadow banking, and there clearly I think that we have moved to like a much better place where the off-balance sheet vehicles that were sponsored via credit lines that were capital arbitrages for the banks, those have been replaced by more like a market-based credit intermediation, which is exactly the kind of development that makes the system safer. Which doesn't mean that there aren't risks, but certainly the risks are much less than what we had in the old shadow banking system. And then there are all these other areas. Macroprudential frameworks is in particular something that the fund has done a lot of work on. And there are, of course, the emerging areas like fintech, where there is a lot of developments. And accounting standards, right? I mean, part of what has made the system safer is the change in accounting standards. So SPVs now, to a large extent, have to be consolidated on balance sheet. And so the conduits are basically no longer arbitrages, not just for capital reasons, but also for accounting reasons. So I want to finish this talk with the following picture. And so the title here is a little bit misleading. So it only applies to the left chart, but not to the right chart. So, so we have seen all this tighter regulations. So the dealers, clearly have stagnated. Leverage has been contained. There has been the substitution into the healthier market-based system away from the old, very risky shadow bank maturity and liquidity transformation. But with that, of course, market making has changed dramatically, right? So when you talk to market participants, either on the buy side or the sell side, they will tell you that market making is no longer what it used to be. You can Google this great photo of the UBS trading floor, right? Out in Stamford, that was the biggest trading floor in the world. This was like the size of something like 2 or 3 football fields. And this is now completely empty, right? It was unwound. And this is just so like a symbol of what has happened. And then you're like, well, is that costly or not? And so, one of the things, of course, it's too early yet to really evaluate the unintended consequences of regulations. But here is one initial sort of like look at that. So here we are using trace data, and we're calculating price impact for corporate bonds. Okay, so this is one very useful liquidity measure. And what you can see is that the price impact for the retail size trades on the left-hand side basically is cheaper today than it was pre-crisis, right? So retail investors can trade very cheaply. But, and this is the important thing, but institutional investors are something like 1.5 to 2 times more expensive, right? And so when you talk to, again, when you talk to buy side or sell side in that space of market making, they will tell you that there has been a transition from the principal trading to agent-based trading. So, and this is what I showed you earlier, right? So it used to be that the dealers had huge inventory of corporate bonds, and they were happy to take on directional trades, and now they are no longer. So if Doug wants to sell an illiquid security to Stan, right, it used to be that, if Bob was the dealer, Bob was like, yeah, I'm going to take Doug's, risky stuff. And now he's like, no, I'm not going to take that. I'm going to look around for somebody to buy this. And then Stan perhaps happens to say, yeah, I'm going to take it. But this might take like a couple of weeks. And so this is why you see that, the trading costs have increased for the institutional size trades, because the dealers are no longer inventorying this kind of bonds. Now, how costly is that? Does that have an impact on the end side borrower? It's hard to say because, of course, QE also happened at the same time. So liquidity costs are higher, trading costs are higher, but then again, interest rates are very low. So, how do you calculate that? So how do you find instruments to really calculate the costs? It's very hard. I've done some work on that does. So you certainly, using like difference type approaches, you certainly do find significant statistically and economically statistically significant effects. But, then you also have to weigh that against the fact that, yeah, we do think that the system is somewhat safer today. So, I think there's a lot of very exciting work to be done there over the next couple of years. And so with that, I want to conclude right on time. I think the regulations have made the system safer. There are some consequences in terms of the cost of credit intermediation, but I think that the overall sort of like punchline for the moment is that probably the system is safer, and the unintended consequences are acceptable in terms of magnitude.